Let's just put the real question on the table. Every serious silver investor is wondering the same thing, even if nobody wants to say it out loud. If things look so bad on the charts, why aren't the giants selling? Where's the panic from the world's biggest market players? And if this sell-off was really the death knell for precious metals, why do powerhouse firms like Goldman Sachs, State Street, UBS, and the World Gold Council keep publishing research defending their bullish stance? Let's break it down. Goldman Sachs, not exactly a group of wide-eyed amateurs, still defends their silver thesis, and in fact, just published fresh analysis. State Street, a financial titan managing a giant pile of assets, describes the correction as a setup, the kind that gives seasoned investors a reason to get excited, not run for the exits. UBS, serving the high-powered world of family offices and sovereign funds, the real smart money, openly called the recent gold and silver crash a prime opportunity for investors who don't yet have enough precious metals exposure. Meanwhile, MKS, PAMP, and the World Gold Council both doubled down on their long-term structural arguments for gold and silver, even as prices hit fresh 7-month lows. So what gives? It's not that these institutions are missing something. They're bigger, more experienced, and better resourced than any retail player watching the charts in real time. If anything, they've seen more market panics, regime changes, and fake-outs than the rest of us combined. These firms don't just survive volatility, they thrive on knowing where to keep a steady hand. This week, 5 of the largest, most influential institutions out there came to the same basic conclusion at more or less the same time. That kind of consensus deserves way more attention than the string of red candles convincing scared investors to dump at the bottom. Smart money just sees price shocks differently, with more context and more tools. Here's what really matters. By the end of this, you'll see what they see. I'll walk you through 5 specific things that came out this week in institutional research. Hard numbers, direct quotes, the exact names you know. You'll understand why, even as silver nosedives, the gatekeepers of hundreds of billions of dollars remain unfazed. Let's get into the data nobody's talking about. The one number almost every retail investor missed this week. It's the figure that, truly, blows up the entire bearish argument people have latched onto. Stay with me for that, because when you see it, the entire narrative changes. Right now, nearly everyone's glued to falling prices, convinced we're watching a disaster unfold in real time. But what we're really seeing is 5 institutional giants, State Street, Goldman Sachs, the World Gold Council, UBS, and MKS PAMP, all releasing brand new research. Their price targets don't match up exactly, but their core message is the same. The second quarter drop changed where you enter, not why you invest. That kind of unified thinking doesn't show up when a fundamental backdrop is crumbling. It shows up when opportunity is lurking under the noise, the kind that heavy hitters quietly prepare to exploit while the crowd runs for cover. State Street, for example, is blunt. The correction is meaningless structurally. Gold dropped 11.7% last month, the largest since the 2013 taper tantrum. Silver slumped even harder, more than 22%. Bitcoin, for reference, fell about 20%. If you adjust for risk, gold did better than Bitcoin. Silver's bigger drop feels awful, sure, but it's not some weird exception. That's exactly how silver acts. When macro risk surges, it gets punished harder than gold, but when the wind shifts, it bounces faster too. It's a classic high beta play, not a sign something is terminally broken. Now, here's the nugget nobody quoted from State Street. Global debt hit an insane $353 trillion in the first half of 2026. Government debt's about a third of that. So, we're staring at a world where every Fed rate hike piles on hundreds of billions in additional interest expense. Big investors have done the math. How many hikes can the global system eat before the cure, higher rates, is actually worse than the disease, inflation? That's the background smart money is focused on, not a month's red chart. Goldman's Samantha Dart dropped a note late June, quietly but firmly holding the line. The target for gold is $4,900 in 2026, slightly down from $5,400. The recent sell-off, Goldman says, is about rate-sensitive demand from the West, not a shift among long-term buyers. Mandate-driven investors, think institutional funds with strict yield targets, Dumped metals once real yields spiked. Not because they've abandoned the precious metals thesis, but because their rules left no choice. And as soon as the rate landscape flips, those funds are primed to return. This is capital in a holding pattern, not fleeing for good. The week payrolls number last Thursday was the first tap on the door for this capital to come back. Here's another stunner from Goldman. Central bank demand for gold is double what everyone thought. They found the UK's official trade data was undercounting vault outflows since last August. Realistically, the world's central banks have been buying 60 tons per month, not 29. These are long-term buyers with multi-decade mandates, not traders chasing quarterly returns. They didn't flinch when the Fed turned hawkish or metals tanked. In fact, their accumulation has ramped up. An OMFIF survey just found that for the first time, more central banks plan to cut their dollar exposure and add gold than the other way around. 30% plan to boost gold within 2 years. That's a historic first, and has nothing to do with whatever the Fed did last week. It's all about the enormous global debt pile, persistent deficits, and growing distrust of using the dollar as a political weapon. Let's talk about history for a minute. State Street referenced the 2013 taper tantrum, which really matters. Back then, the Fed's hint at slowing asset purchases sent markets spiraling. Gold crashed about 28%, silver 35%. Everyone thought it was all over. But when the Fed actually pulled the trigger on tapering, the world didn't end. Real tightening was much less painful than the panic leading up to it. Gold and silver both bottomed before policy even changed and recovered after. Why does that parallel matter now? Because this cycle is just a rerun. The market is freaking out over the prospect of hikes, not the hikes themselves. The spike in inflation is traceable to energy shocks, not some deep, unfixable problem. Last time, those who held through the fear phase ended up reaping the entire recovery. Right now, every institutional note is telling you directly. They're following that playbook again. Let's look at the actual performance. Silver fell over 50% from its peak. But get this, it's still up 63% from 12 months ago. Read that again. 63% above last year's price, even after all this chaos. In what other market could you boast a 63% gain and feel like you made a mistake? That's the psychological trick brutal corrections always play. They get you obsessing over the short-term top, not your long-term baseline. The case for a structural breakdown means ignoring every gain that came before, pretending this is a collapse instead of a retracement from all-time highs. In reality, every commodity that's ever made a multi-year run has endured corrections of 40 to 50% along the way. Silver at $62, down from $121, is dramatic, but totally within the historic pattern for a market in a mid-cycle correction. What's even wilder is that, under the surface, the physical metal market is still tight. Goldman points to persistently thin inventories. Silver's supply deficit cycle is going on 6 years now. Lumpy restocking demand from solar and EV manufacturers, paired with above-ground inventory drawdowns, is just starting to build. When these buyers move, they don't trickle back in. They pounce all at once when they sense the worst has passed. Meanwhile, the smart money is ahead of the game already. Managed money long positions in silver have been ticking higher, even before the jobs number triggered last week's big move. Institutions are quietly rotating back in while the crowd debates, has the thesis broken? UBS laid things out even more clearly. This pullback is a big, bold loading zone for under-allocated investors. Their forecast for gold is $5,200 in a year. They think the Fed stays on hold through 2026, cutting rates only in 2027. The jobs data is already forcing investors to reconsider just how aggressive the Fed can be. Rate hike probabilities have been chopped in half in a matter of days. Markets price out more tightening, and precious metals catch a bid. Every big data point coming this week, services PMI, FOMC minutes, jobless claims, has the chance to weaken the rationale for higher rates and refuel the demand for gold and silver. The setup is simple. As rate hike odds drop, the institutional money that was forced to sell by mandates starts rotating back. That's how you get markets that bottom hard and rally just as fast. One last thing worth repeating. Goldman's holding an $85 average silver price in 2026, labeling it the backbone commodity of the green energy revolution. That's no small thing when current prices are well below that, and inventories are running on fumes. The LBMA survey pegs 2026's average at nearly $80, a whopping $17 above where silver trades today. So, what's the takeaway? Watch what the biggest money is doing, not what headlines are screaming. 5 global institutions remain believers in the metals thesis and see this entire sell-off as a setup for the next wave. The second quarter knocked the price down, but it never knocked out the structural case. Silver has climbed 63% in the last year, survived a textbook correction, and stands in a global market with shrinking inventories and restless, cash-rich buyers. This is what a structural bull market looks like in its toughest phase, the one where most people bail and the patient, disciplined money gets paid. Smart money isn't sweating this sell-off, and now you know why. You know exactly what's under the surface and exactly what catalysts lie ahead.